Hey there, and happy Tuesday, everyone. Welcome to another episode of SRT Live. I am your host, Sean, with the Sean Richard Mortgage Team. Are we in for calm waters this week, or are we going to see rough seas? We're going to be talking about that today as we get into inflation data. But as always, let's kick it off with the week in review. Last week, we had some shenanigans in the mortgage and economic markets. Last Tuesday, we saw Fitch, a credit rating agency in the capital market space, came out and downgraded the U.S. credit rating from AAA to AA plus. Now, that may not sound like a big downgrade, but what it did was it sent the markets into turmoil. It was trouble. We saw the stock market sell off. We also saw mortgage rates climb higher on Tuesday by a healthy margin. Now, if that wasn't enough, on Wednesday, we got ADP's monthly payroll report. Remember, ADP is the largest provider of payroll in the country. So we got their payroll report, and it came in significantly higher than expectations. 135,000 more job creations than expected is what they reported, and that put added pressure on the labor market. It really indicated how tight the labor market is still staying, and that's a problem for the Fed. That's a problem for inflation, and so that caused mortgage rates to climb a little bit higher on Wednesday. We saw a little bit of follow through on that climb higher on Thursday. And on Thursday, we got the jobless claims. As we do every Thursday, we got initial claims, which is individuals filing for unemployment for the first time. And then we also got continuing claims, which is individuals renewing their unemployment benefits. So initial claims came in right in line with expectations at 227,000 new claims, and continuing claims came in exactly on expectations at 1.7 million as well. So not a whole lot of change from the previous readings. Initial claims were up about 6,000 from the prior reading, but claims in general have kind of stayed back a little bit lower on the spectrum. Over the last 12 months, we've seen initial claims fluctuate from the 180,000 range to about the 260,000 range. And so we're sitting right in the middle of that range, waiting for a breakout in one direction or the other. And Friday's jobs report from last week could be an indication that we're starting to see the labor market cool off. Market analysts were expecting 200,000 new jobs created for the month of July, and the numbers came in at 187,000. So a slight miss on the jobs report, but this was actually positive enough news to move the dial or move the needle on mortgage rates. We saw mortgage rates Friday gain back a good chunk of what they lost Tuesday through Thursday. So that was a great sign heading into the weekend. Unemployment did dip from 3.6 to 3.5%. But remember, we've got two different surveys. The jobs report is coming from the business survey, where employers are surveyed, and then unemployment rate is coming from the household survey, where households are surveyed. So different sources of that information, and that's why you sometimes see them move in opposite directions. Now, fast forward to this week, we've started off the week with some very low-key environments. No major economic data is coming out yesterday or today. We're not seeing a whole lot come out tomorrow. So we've started with very calm waters. However, we finished the week off with some blockbuster information. On Thursday, we get CPI. And if you've been watching me, you know exactly what that is. That is Consumer Price Index. This is one of the three major inflation reports that we get on a monthly basis. CPI is inflation at the consumer level. And we get month over month numbers and year over year numbers. This is a really important report. If we see inflation stay stagnant or climb, that could spell bad news for mortgage rates. So we're going to watch that closely. Then also on Thursday, as we always do, is we're getting our unemployment claims. We like to watch that because that really gives us an idea of how tight the labor market is. You heard me talk about the, I guess, the life cycle of hiring and firing from a company standpoint. The initial jobless claims are really at the end of that cycle. For those who haven't watched recently, let me run through this real quick for you. So we start with a company hires employees, right? Things are going well, they bring on more employees, and they're cruising along. Well, when things start to get tight, the first thing the company does is not let those employees go. The first thing they do is they slow down on hiring. Now, if that's not sufficient to get them where they need to be on their business finances, then in some cases, before letting people go, they're going to cut hours. Maybe instead of having 40-hour employees, they have 35 hours or 38-hour employees. That helps cut costs without having to let go of employees. Then, if that still doesn't get them to where they need to be, the environment gets tighter, then at that point, they may start looking at letting go of employees. So those jobless claims numbers are at the tail end of that cycle. And so once we start seeing those numbers increase on a significant scale, that's when we can really say that, okay, the labor market has absolutely softened. But when we see the Board of Labor and Statistics jobs reports come in below expectations, it's also a good indicator. So we're watching that as well. Now, on Friday of this week, we also get PPI, which is Producer Price Index. So this is wholesale inflation. And this is important because this kind of gives us a lens into what we could see in consumer inflation the following month. Producer inflation or wholesale inflation, not all of the cost increases or decreases are going to be passed along to the consumer. So it at least gives us a little bit of insight as to what we may see going forward. Okay, so what does it all mean? What are we focused on going forward this week? Well, we're very focused on inflation this week. With two inflation reports coming out this week, this is going to be important data for the Fed, who doesn't meet again until September, to help determine what they're going to do at their September meeting. Now, we're going to get another inflation report towards the end of August. That's going to be PCE, or personal consumption expenditure. It's just one more inflation report. That happens to be the Fed's favorite measure of inflation, but CPI is an important measure as well. If these inflationary numbers come in better than expectations or lower, then that could lead the Fed towards continuing or pausing, not continuing, pausing their rate hikes. Now, if this number comes in line with expectations or higher than expectations, which there are some rumblings that it could do, then we could see the Fed continue hiking rates. One of the hurdles with the Fed hiking rates is there's a fear that they may do too much. The Fed is always looking at rear view mirror. They're looking at lagging indicators, and that leads to the potential of over tightening, because ultimately that's what the Fed is looking to do. They're looking to tighten economic policy and slow down the economy to avoid or to bring inflation down. And so if they're looking at almost exclusively lagging indicators, then that opens the door to them doing too much. And then all of a sudden those lagging indicators catch up and it looks like we've gone too far. The other piece of the puzzle, as far as the Fed and the rate hikes going forward, is we're getting mixed messages from the Fed. We've had some talk of the Fed needing to continue to hike rates, calling for one or two more hikes throughout the rest of the year. And then there's been some talks of having to be very data dependent, as we've heard from Jerome Powell over the last couple of press conferences that he's done. And because we're getting these mixed messages, it's becoming a little bit harder to truly understand what the Fed is going to do with their next meeting in September. But the inflation reports this week, as well as the PCE inflation report towards the end of the month, are going to really help us determine what's likely going to happen with the Fed. And ultimately, that's going to have a significant impact on the economy. So if you have any questions about how all of these things impact the economy, or you just want to talk about home buying and the market and what makes sense for you, definitely reach out to my team and I. You've got my number right here. Feel free to leave comments down below. And as always, if you're a real estate agent and you want to get together to strategize about how to have more impactful conversations with your clients, that's what I'm here for as well. But for this episode of SRT Live, that is all I have for you today. I just want to say, if you're a member of our Powerhouse Facebook group, thank you so much for being an incredible part of our community. If you're checking us out on our YouTube channel, make sure to hit that subscribe button so that way you've got economic, real estate, and mortgage news at the palm of your hands. Thank you so much for joining me today. Have an amazing rest of your week. Take care.